Let's bring in SoFi's Liz Thomas, New York Life Investments' Lauren Goodwin, Morgan Stanley Wealth Management's Ellen Zentner. It's great to have everybody here on the desk with us. All right, Liz, you first. What do you think about what Mr. Lakos had to say? Base case 7,500, bull case 8,000.
So when I look at in 2026, first of all, to your point, not a lot of bears to be found, and I think that's warranted. There aren't a lot of really strong reasons to be bearish into 2026, aside from looking at the market right now and realizing, okay, the chase that we all expected into the end of the year maybe didn't materialize and maybe isn't going to materialize. So everybody saw the opportunity for this big chase back into a lot of those AI names, back into a lot of large cap tech, and we thought that this rally would just kind of get unhinged through December 31st. Perhaps not. The broadening out of the sectors that are now participating in the market rally, if we're going to still call it that, I think is very promising. And I think that will continue into 2026. Dubravko's point about that being more of a tactical short-term broadening out, I would maybe respectfully disagree with. I do think that there's opportunity for other sectors to really step into the limelight
Well, I think
next
it's
year.
dependent on, in his mind, if the Fed cuts rates and the economy remains strong enough, then clearly the cyclical areas of the market are going to do well. If something upsets that story, you could easily see how those areas that are more geared towards cuts and economy aren't going to do great.
Yes.
We're trying to front run this now, right? This is what people are positioning for, that so-called run it hot.
Yes.
Well, run it hot can't become not, or it's not going to be good.
I think in the first half of the year, it actually can still be that way. We're positioning for the Fed chairman to change in May, and we're expecting that that chairman is going to be friendly to the administration from a dovish perspective. We're going to probably expect that maybe they hold off on making a lot of big rate moves until after the new chairman is in the seat. So I think that we still have a decent amount of runway, January through May, of expecting there to be still dovish support from the Fed. Not to mention, we just got an announcement that they're buying $40 billion a month of treasuries until probably mid to late April. So the support is there from the Fed for at least the first few months of the year, and we've got the stimulus coming. I think that the rotation can continue to stay the way it's going. I think that we can see a lot of strength from other sectors, and I am pretty bullish going into 2026.
Sound good to you?
It does sound good to me.
Do you agree with it?
I do agree with it.
Oh, it sounds really good. Is it true? Can it happen?
I think it can. We are, especially given some of the data that we're finally seeing this week, we're seeing the reality of a little bit of a growth soft patch in Q4. And the market is necessarily going to be digesting and reflecting that. As we turn into the first half of the year, I agree. We expect that the Fed is going to be cutting, albeit slowly. We agree, actually, that we'll probably only see one cut in the first half of the year because growth is resilient. But we're seeing fiscal support ahead of the midterm elections. We're seeing a geopolitical backdrop and an AI backdrop that's fueling investment. This is a pretty good story for the economy and markets.
Ellen, does that make sense to you?
Yeah, well, I'm gonna respectfully disagree with the gentleman.
Okay.
So I don't think it's a disaster for the
this
market.
This one or that one?
Well, your present company excluded.
Thank you. Thank you.
I don't think it's a disaster for the market if the Fed does not cut next year, because if they don't cut next year, it's because they don't need to. And you've got cuts in the pipeline. They're still going to be impacting financial conditions. They are still sterilizing Treasury's T-bill issuance by investing the $40 billion back into the short end of the yield curve. And there are myriad ways the economy can have really nice, robust growth next year, even if the Fed does not cut further.